Hey, what's going on, people? It is Tuesday, and yes, I am outside. And thought about something. I was listening to some people complain about the weather, and they said that it's so hot out here that it didn't make any sense. Well, actually, it does. It's almost the end of June, my birthday month. And as you can see, I had back today, and I went to the gym and worked out, and then jumped on a conference call. And, you know, when we talk about the financial environment is kind of hot too, depending on when you get in it. So, some of you may know that I'm a digital asset certificate for financial professionals. And so I know a little bit about crypto. So today's message is going to be talking about, is the market hot? Now, some of you may own Bitcoin, may own Ethereum, may own Solara, XRP, XLM, Doge, whatever it is, you own it. And some of you bought it when the market was pretty low. And then some of you bought it when the market was high. And so you've seen the ups and downs of the market. First of all, you should not be putting more than 5% of your total assets in crypto. To be safe, 1 to 2% would probably be good. But for some of you, you like taking a lot of risks, because you've heard advisors say, and I've even said it, the greater the risk, the greater reward. The lower the risk, the lower the reward. But guess what? That market is hot, meaning it could go up or down. So, with that said, I'm advising you to seek wise counsel when it comes to the crypto market. Because right now I'm in the shade, but soon that sun's gonna hit me. And I just want you to start thinking about, is the market hot or not? So if I had to invest in crypto right now, and people were asking me which crypto I would invest in, I would tell you, and I hope you're listening, the ones that have the right utility, meaning what it's actually going to be doing, is the ones I would look at. Now, when I say utility, what I basically mean is it something that people can utilize? You know, some of these tokens are gamified, and some of them are just garbage. And then some have utilization. So I'm not telling you which tokens or coins you should buy, because that is not something that I personally do. I don't get on, say, oh, you should buy this because it's going to go up or it's going down. What I tell people to do is they need to research, read the white paper, and there is a white paper out there for most of these coins. Do their research and study before they invest. Now, here's a true story. When I first started learning about crypto, before I decided to get certified and take a course and work on some stuff, I went with the latest and greatest people on the internet talking about what they could do and how they could teach you and their courses and all that. And I got scammed by an individual because I didn't know anything about how to set up an account, what to actually do. what a cold wallet was, a warm wallet, a hot wallet. Didn't know any of that. It was through time and trial and error that I learned these things. And some of these platforms have tutorials on it and good study platforms where you can learn about crypto. And then some of them don't. And I'm not going to refer you to any exchanges. I'm giving you terms that you might need to know. But if you're going to start doing decentralized money, or where your money is not controlled by banks and you're essentially the bank, you need to learn this cryptology, right? You need to understand why crypto was developed. You see, the US dollar, I believe it was 68. Nixon took us off the gold standard. And by taking us off the gold standard, that meant that the United States could just print money without it being backed. Now, the way the American economy works, and banks have figured this out because they do what they call fractional banking, the Federal Reserve sets a requirement that banks must have in their accounts at all times. And let's just say that's 10%. I don't know it to be true, but let's say it's 10. So for every dollar that you have, they can loan out 90% or 90 cents on every dollar. Now, the funny part of this is, it goes back to the rule of 72, is that you as an individual don't understand the rule of 72. And you for daggone sure don't understand how banks have been taking care of you, or not taking care of you when it comes to their lending practices. Now, we have the Fair Credit and Lending Act, but if you don't take the time to read that stuff, well, let me put it this way. My grandfather used to say, what the big printeth saith, the little printeth taketh away. Now, how many of you've gotten things from your bank in the mail and they send you this pamphlet and they say, oh, we've changed this, but they don't ever tell you what they changed. They give you the whole thing and expect you to read the whole thing. And what do most people do? File 13. They don't read it. And then when they say, well, this is changing, this is why, and then you say, well, nobody ever told me that. No, that's not true. We mailed it to you. Or we emailed it to you. Or we had it on a little disclosure. So I'm saying to you that this banking thing, this crypto thing, whatever you want to call it, you got to start reading the fine print, people. So as I walk and the sun hits my back, you too will learn some of the tricks of the trade that banks have used, which instead of putting your money in the bank on what I call bank day, and bank day is every time they get a deposit because you don't know how to hold your own money. What you now got to do is you now have to learn how to lend your money out versus them lending your money out. See, they're only paying you probably less than 1% on your money. The rule of 72 tells you at the exact point in time that your money will compound, double, or grow. Now, the problem I see is that nobody has ever taught you this, or if they did, you don't remember it. So we're going to do a little quick lesson. 72 divided by the interest rate tells you the exact point in time your money will compound, double, or grow. So if it's 72 divided by, 3%, take you 24 years for your money to compound, double, or grow. Now, here's the flip side of that. Some of you, for lack of better words, you don't think about your money growing. You don't think about how your money should grow. You don't think about any of that. What you are is you are a slave to the lender, meaning that you have put your money into an institution that gives you less than 1%, which means that if your money sits there in that institution, that would take 72 years for it to double. So whatever that amount of money is. So when we talk about that, in essence, what we're talking about is that individuals don't know that. But then you'll go get a credit card for 10% or 12 or 15 annual percentage rate. And what they're saying is to borrow their money, which is really not their money, it's your money. They earn interest by giving out a credit card. So now the question that I ask you is this: since they made money off of your money, why aren't you making money off of your money? Oh, you never thought about it. So what I just said was they give you 1% or less than 1% at most banking institutions. They loan your money out to you and others to buy a house, to buy a car, to do a personal refi on debt, or to basically get money from a credit card, lending you money so that you can acquire stuff. They charge you extra money. Now, if this doesn't upset you, I'm sorry. I wish it did, but it's not upsetting enough. You know, it's hot out here, but I'm still getting my walk-in. See, a lot of y'all are getting your walk-in every time you charge that card and you don't pay it off. You pay monthly payments. Now, there are some cards out there where you got to pay it off every month, but people don't like that because then they got to have discipline. They got to basically pay it off. So, and what happens? We spend more than what we make. So that problem then affects someone else, right? Because you're not budgeting. Now, you're probably saying the financial first responder is just rambling right now, but I'm not. I'm actually dropping nuggets. And for some of y'all won't take time to listen to this message because it's not what you want to hear. If I got up here and said, oh, I got to wait for you to make an extra $1,000, $2,000, $5,000, $10,000, you'd be all ears. But what if I do have a way? That way is not getting charged all that interest. So with that said, one of the ways you can not get charged all that interest is you can watch your spending habits. Yeah, I said it. Watch your spending habits. You know, I keep getting people calling me, well, not calling me, but emailing me. And they're basically saying, hey, we can lower your interest rate on your car payment. And I'm like, oh, well, that's great. But then when you refinance, you start the whole daggone thing over. No, I'm good. Did you know you can pay your car payment bi-weekly? I pay mine bi-weekly. Cuts down on the interest, you pay it off faster. And for those of you who have luxury vehicles, it allows you to reduce that principal faster with a lower interest rate. So those loans, banks don't really want you to know about them because they lose their interest. And when you pay bi-weekly, you pay it off earlier. Pay it off really quick. So, how you doing, sir? So those are the things and the strategies that you need to do to be financially astute. Let's see, what else? Did you know that if you paid your credit card more than the minimum due, you pay it off quicker? Oh, and while I'm on this point, you want to keep your credit cards 30% or lower. Once you get over 30% on a credit card, then it messes with your credit score. And the reason why that's important is because when it messes with your credit score, then you end up paying more interest because you're a credit risk. So you're probably saying, well, I don't know that I'm a credit risk. And I'm saying, well, you might not think you're a credit risk, but actually you are. If you lost your job and then couldn't pay them back, then they won't ever get their money back. So that's a credit risk. Now, while I'm on this point, what else could you do? You could be on a budget. You could start paying your debt down from the avalanche or from the snowball effect. So I know you're probably like, what is that? Well, either come to one of my seminars or look it up yourself. Those are techniques that financial planners can help you do to reduce your debt. One being able to pay down your largest debt to your smallest, and the other paying your highest interest rate card off first and then going to the next highest until you get to your lowest interest rate. So you want to be in a situation where you're paying yourself off and you're saving money. But most of you can't save money because you got too much debt. It's amazing to me how many people can't save 10, 20, 30% of what they make. Now imagine if you were making, I don't know, let's say $100,000 a year for practical purposes. You were able to save $10,000 this year, $20,000 next year, $30,000 the following year. You'd have over $60,000 saved in 3 years. Crazy, right? Or what if you could live off of 50% of what you make and save 50%? Or what if you could live off of 70% and only spend 30% of what you make? So that same 100,000 would be 50, 50, 50. That's 150. Or if it was 70%, that'd be 140 plus another 140 plus another 60, 210. Yeah, be 210 you'd saved in 3 years. Now, what would your life be like if you had $210,000 saved? Wow, be nice, right? Well, I don't want you to save more than $250 in any account with the bank, because FDIC insurance will only cover up to $250. Provided you don't have multiple accounts, joint accounts. There's some rules to that. But you want to think about, you're letting the bank loan your money and pay you 1%. Now, there are programs out there where you can become the bank and loan your money out and get a higher percentage. But that takes some education. That takes some learning. That takes some understanding of what you should do and when you should do it. And for some people, they're just not going to take the time to learn it. Now, the flip side of this, we talked about crypto. We talked about banking. You can save money in insurance policies. And most of you are like, oh, I don't want to leave my money to the insurance company. Well, they pay a higher interest rate than banks, even high yield banks. Then there's notes and there's liens, tax liens. There's a lot of different places that you can save your money. Now, you won't be able to get to it right away because you're locking it in, but that's locking it in allows you to get the extra money. Mr. Financial First Responder, you mean to tell me there's not an investment account that I can put my money in and I'm guaranteed money? No, it's not. Every account has some form of risk to it. Risk of default, risk of potential market. There's a whole bunch of risks. So I'm saying that to you to kind of get you thinking about that. If anybody tells you there's no risk, that's a lie. There's always risk. Always. Never such thing as not a risk. There's a risk of living, a risk of dying. There's risk. So when I say that there's risk, it's risk. So when you walk across the street, you look left or right, right? You look for risk. A risk of a vehicle passing by and hitting you, or something being in the road that could hurt you. It's always a risk. Well, this is Mike Barnes, the Financial First Responder. Please like my channel. Please subscribe. Click the link below if you want more information on risk versus reward, crypto versus regular currency, being a lender versus a borrower. Remember, in the Bible it says the borrower is the slave to the lender. It actually says that in the Bible. But for some of y'all, that's not your book of choice. However, you might want to start letting it be your book of choice. All right, guys, I'm going to keep walking. I want to make sure that I get my walk in. And I want to tell you, God bless you. I hope he smiles his blessings upon you. And that you have a great day. This is Mike Barnes, the Financial First Responder. God bless.